Rajalakshmi College of Arts and Science. A warm welcome to my YouTube channel, Learn to Win. Today we are going to discuss about the topic of direct tax. Direct tax, as you all know, it is the one type of your income tax. That is, the income tax includes two types. One is your direct tax, another one is your indirect tax. And the direct taxes or the taxes that are imposed directly on individuals or entities and are paid directly to the government. These taxes are levied on income, profits, and wealth. Unlike indirect taxes, which are imposed on goods and services, direct taxes are levied on the income or assets of the individuals and business. The burden of the direct taxes cannot be shifted to others because they are directly paid by the taxpayer. Same way, the direct taxes are often considered to be more equitable way of collecting revenue because they are based on one's ability to pay. However, they can also be more complex to administer and may face challenges related to tax evasion and avoidance. The implementation and the structure of direct taxes can vary widely among the countries depending on their economic policies and priorities. The direct taxes, the commonly it includes the income tax, that is the income earned by the individuals and the business. The income tax rate may vary based on the level of income and it's often progressive. That is, higher the income percentage of the taxes, lower the income, lower the percentage of the taxes. That is your progressive system. And then after your income tax, next type of the direct tax is your corporate tax. This is a tax on the profits of corporation. The rate may vary again according to the jurisdiction and the size of the company. And next one is your capital gain tax. Capital gain, again you can short out into long term capital gain and short term capital gain. Long term capital gain, it is more than 36 months. Short term capital gain is less than 36 months. This tax is applied to the profit realized from the sale of the assets such as your stock, real estate and other instrument. Here also the rate may differ according to the longevity of the particular assets. Okay, then next one is your property tax. That is, the tax is levied on the value of real estate properties owned by the individuals or the business. So still now we have discussed about the various types of the direct taxes which is included. So you can clearly have a clear picture of what is direct tax as well as what is indirect tax and what are the taxes which is included in your direct tax also. Okay, and then the Income Tax Act, it was passed in the year 1961 with the effect from the first day of April 1962 under the section 1, and it contains 298 sections, subsections as well as schedules, etc. And the income tax rules of 1962 was framed by the Central Board of Direct Taxes. In short, we say that as CBDT. And the other terms which we have to understood, it includes your assessment year as well as your previous year. Assessment year under the section 2 subsection 9. The term assessment year is commonly used in the context of income tax and it refers to the year in which the income is assessed for taxation purposes. Any money tax systems, it includes, that is particularly in India, the assessment year follows the financial year. That is, the financial year is from, for example, 1st April 2022 to 31st March 23. Simply, it starts with the 1st April and ends with March 31st. And the corresponding assessment year for this particular financial year according to our example, that is 1st April 22 to March 31st 2023, our assessment year will be 1st April 2023 to 31st March 2024. During the assessment year, the taxpayers are required to file their income tax returns, and the income earned during the previous financial year is assessed for the taxation. The point which we have to note very clearly is regarding for which income we are going to pay. We will be paying for the earned income only. Okay, that is regarding your previous year. And then the next term which we have to understand is your assessee. The assessee, according to the section 2, subsection 7 of the Income Tax Act, it includes the contest. Otherwise, requires the term assessee means a person who is responsible for payment of any tax or any other sum of money under this act. And also the next term which we have to understand is regarding the person under section 2 subsection 31. It includes HUF, that is Hindu Undivided Family, company, firm, association of person, body of individuals, local authority and artificial judicial persons. And the next term is regarding your agricultural income, as maximum number of our earnings is from the agricultural land, and our main source of income in India is regarding your agricultural income. Its income refers to the income earned or revenue derived from the sources that includes farming land, buildings, and which is identified as the agricultural land, and commercial produce from a horticultural land. This agricultural income is defined under section 2 subsection 1a of the Income Tax Act 1961. And then different types of agricultural income goes on like rent or revenue derived from the land, income from agricultural operations, income from farmhouse, that is building attached to the agricultural land. And next one is your non-agricultural income from land, that is income from markets, income from stone quarries, then mining royalties, and then land used for storing agricultural produce, supply of water for irrigation purpose, self-grown grass and trees, and then income from fisheries, and then remuneration received as manager of an agricultural farm, and then income from interest on arrears of the rent of the agricultural land. All these things includes your non-agricultural income from land. And next topic is regarding your residential status. That is nothing but a particular person, that is an individual staying in India for how many days in a particular previous year. That is the residential status calculation. So you should not confuse with the citizenship of an India as well as his stay in India. That is clearly mentioned in this particular slide. The term residential status has been coined under the income tax laws of India and must not be confused with an individual's citizenship of India. An individual may be a citizen of India but may end up being a non-resident for a particular year. It depends upon the number of days he stays in India. Similarly, a foreign citizen may end up being a resident of India for income tax purpose for a particular year. It is also depending upon the rules which is given under the Income Tax Act 1961. So how we are going to determine the residential status? To have a clear picture, we have classified this residential status into three categories. One is your resident, and the next one is a resident, not ordinarily resident, and then a non-resident. Okay. The taxability differs for each of the above categories of the taxpayers. Before we get into the taxability, we have to understand how a taxpayer becomes a resident and not ordinary resident. That is resident, not ordinary resident, and non-resident. Okay. So this figure will give a very clear picture about your residential status, how it is divided. So it is divided into mainly into two. One is resident and not resident. Again, the resident is divided into two. One is ordinary resident, another one is not ordinarily resident. The sections goes on like section 6 under your residential status of an individual. Then next one, section 6(1) is your resident. Non-resident is section 3 subsection 30, and then finally 6(1) is again divided into not ordinarily less than, that is section 6 subsection 6. So when he want to qualify himself as a resident first, he has to check for the two conditions. One is his stay in India for a year, it has to be more than 182 days in the previous year, or else his stay in India must be at least 60 days in your relevant previous year, and again 4 previous years preceding your relevant previous year, his stay in India, it has to be more than 365 days. Okay, so with these two conditions, among these two conditions, if he is able to fulfill any one, he will be able to be the resident of India. Okay, in case if he is not able to satisfy both the conditions, he will be said as the non-resident. Okay, he'll be going automatically to the last one, that is non-resident. If suppose he is able to claim as the resident, then he can again claim to the next status, that is your resident but not ordinary resident. For that, his stay in India has to be 2 out of 10 financial years, that is preceding your previous year, or otherwise stay in India for at least 730 days in the 7 previous years preceding your previous year, relevant previous year. So this is the case. If suppose if he is able to satisfy any one among these two conditions, that is 2 out of 10 financial years, and then 730 days in the 7 previous years, that is both case before the relevant previous year, then automatically he can claim as resident as well as resident but not ordinarily resident. In case if he is not able to satisfy the resident, automatically he will be considered as the non-resident. Okay, same way in case of your residential status, after knowing about the calculation of the residential status, whether it is a resident, not a resident or non-resident, we should have a knowledge about the calculation of the uh, scope of total income. That is your basis of charge in which we are going to calculate the incomes. Okay, so for this purpose we are categorizing the incomes as income received in India, income deemed to be received in India, then income accrues or arises in India, then income deemed to accrue or arises in India, and finally, fifth one is income accrues or arises outside India. Then income accrues or arises outside India from business or profession set up in India. Finally, income from other sources. Okay. So here in case of your resident, not ordinary resident and non-resident, for the first two categories, it is fully taxed for all the persons. But in the next fourth category, it is taxed only to resident and not ordinary resident. And in case of your fifth category, it is taxed only to the resident. And then in your sixth category, again it is taxable to resident as well as not ordinary resident. And finally, the seventh category, it is taxed only to the resident and it is not taxable to the not ordinary resident and non-resident. So in this video, we have had a clear picture of what do you mean by your direct tax. What are the main terms of your direct taxes, like your previous year, assessment year, and then as who's and as C. And we have seen the calculation, the main provisions related to your income tax, that is residential status of an individual as well as the scope of your total income. Thank you for watching my video. Kindly be supportive for the further videos also. Thank you for watching. Thank you.